it is not previously issued, that can be tradable at par, that can be sold at par. So if it is a new issue, now if the government security also, if a new bond, so then previously not issued, then you can purchase or you can sell at par. So very unlikely government security is issued at par, provided it is not now. Generally, we can see primary treasury bond auctions. So those are previously issued. The balance part only they issue. So if the previously not issued, if the previously issued one, there's special character there. You have what? Accrued interest. Accrued interest. If it is previously issued, what do you mean by accrued interest? From the last coupon date to the settlement date. You have purchased it today, last coupon date to today. Now, who will be the entire, now, who is the owner of that particular one, particular interest coupon? Seller. But ultimately, what happened on the on the coupon date, the entire thing will be credited to the present owner, which is not correct. Coupon, the balance, from the last coupon date to the settlement date, the new purchase date, the coupon is belong to the seller. So how we have learned that how do you adjust it? Through the selling price. So we have done that in the class. And pricing of treasury bills is straightforward. 100 divided by 1 plus R divided by 360.2 D, number of days. Now remember the number of days, so always should be remaining number of days, right? Now for example, if it is 91 days, that is 3 months. 91 days previously issued one. After 1 month, I am going to purchase. After 1 month means after 30 days. But for the calculation, you should not take the 91. You should take 61, remaining maturity period. You have to always take the remaining maturity period for the calculation. Treasury bond also the similar. 5-year bond issued. After 2 years time, I want to sell. Previously, I have purchased. Now, debenture I have purchased initially for 5-year debenture. Now, after 3 years, I need to sell. I don't want to keep it until it's get matured. So then, remaining maturity period, only you have to take it. The number of periods depends on what? Now, number of periods depends on the frequency of coupon. Frequency of coupon will be the determinant factor for the number of periods. So, balance period is now 5-year debenture. I'm going to purchase. I'm going to sell it after 3 years. Then how many periods remaining? 2 years. So, if it is semi-annual, only 4 periods. Right? So, the remaining maturity period only you have to take it for the calculation. Remember that. That is important. So, likewise, treasury bill is straightforward calculation for the pricing. Treasury bonds are not straightforward, but it has to go project appraisal mechanism. So, you have to find out the present value. Present value. So, all these cash flows bring into today's year 0. So, you have coupon interest depending on the frequency of coupon payment. And the final you get 100, that is face value. Those are the only 2 cash flows available. So then you do the discounting. How do you do the discounting? Required rate of return. Now, what do you mean by required rate of return and expected return? So today we'll be learning expected return as well. Now, expected return is the meaning of the instrument itself gives. There is an instrument, it gives this much. It gives 10%. But that is not the rate I need. That I need rate, that is the required rate of return. I need 12%, but the instrument gives only 10%. So that is there is a difference between expected return and the required rate of return. The deviation is the risk, right? Risk is measured by standard deviation, right, for the portfolio. Now, like that, you bring all these cash flows into today's term, that is discounting, and you find out the present value. Now we have learned how do you find out the present value. Well, if it is 10%, 1 divided by 1.1, and keeping that is on your calculator. For the second period, you divide that answer by 1.1 again. If it is 1%, it is 10%. So the discounting factor also has to be factored according to the number of periods. If it is semi-annual, discounting factor has to be divided by 2, that is for 6 months, semi-annual. If it is quarterly, then discounting factor also has to be quarter. Monthly, same. So the basis for the number of periods, also the same basis should be applied to the discounting factor as well. We have done in this class, and the discounting for the government security as well. So the money market instrument is treasury bill, treasury bonds are capital market instrument. Treasury bonds are very similar to the debenture issued by the private entities. Now, if you take your bank issued debenture, that is what. So very similar to treasury bond, but we don't call it treasury bond. Why? Treasury bonds are issued by only the government of Sri Lanka. So the debenture we call similar to treasury bond, and also we can call them corporate bonds. Very similar. Features are the same. There won't be any features different. Now recently, the banking sector issued debentures. If they want to take into the capital, we discussed in the class, that is convertible debentures. So the under Basel III requirement not issue convertible debentures for the private banks. So the private banks are issuing convertible debentures. So meaning is, before it's get matured, they can convert this liability into that instrument into equity. That feature is available if it is convertible debenture. So then you can take into the Basel III capital requirement. Convertible option has to be there. Then how does the government bank, how do the government banks issue debentures to raise funds? If the government does not provide the funds, money, capital, they'll have to grow the business. So how do they find money? One thing is deposit, but provided that they want to go for borrowing for the debenture issue, they can raise funds through debenture, but they can't take into the capital if this convertible option is not there. So they can't issue convertible debentures. Why? There is no shareholders, no share capital. Share capital is there, but only the one shareholder is available. That is the government, not like private banks. So what is the instrument they issue? Can be tested. So what is the instrument they issue? They issue additional tier 1 instrument, AT1 instrument. So what is the special feature there? It's a perpetual bond. Perpetual. There is no maturity. And also, instead of convertible, they include what? Callable option. Callable option is what? Callable option is there. So you can call before it gets matured. Who has the right? Who has the entitlement to call? Issuer or the investor? Issuer has the right. Convertible option, who has the right? Investor has the right. So the callable option is available with the issuer. Issuer only call. So after 5 years, they will call at any time. If the interest rate comes down, now for example, now the people have the banks have issued at 9%. For example, the AT1 instrument, additional tier 1 instrument. After 5 years, they check the market. They can issue same instrument at 3%. So why do you want to pay 9%? So you call it execution of callable instrument. Who will be the detrimental position? Who will be the victim? The investor only. Investor was why? Investor was thinking that I can get 9% for indefinitely, but here the issuer has executed its rights of callable option. So then, if it is a detrimental, if it is a bad impact to the investor, so you have to pay more, or the issuer has to pay more. So comparatively, other instrument, other normal debenture for the AT1 instrument, since it is callable option available and the perpetual, there is no end, there is no maturity. Because of these two features, you have to pay more. Issuer has to give more. Issuer has to give more yield to attract the investors to invest. Right? Now the Bank of Ceylon has issued twice, and the People's Bank also on the card to issue AT1 instruments. So the government banks that is the only option available for them. The only option available for them. Only option available for them to issue a 81 instrument to raise capital, so that you can then take into the capital the amount you raise as debenture. And we also did some pricing. Important one for you to learn the pricing of treasury bond. And also we discussed accrued interest part, dirty price minus the clean price is the accrued interest. And the meaning definition of accrued interest also important for you to learn. And we have then moved to shares. Shares, so we have discussed the share market and how do you determine the buying of shares based on what. Only what are the instruments available in the CSE and the boards and the price indices. We have learned also price index and then S&P index and also the boards, main board, the Dirisavi board, default board, MCV board, then Empower board, all those things. And recently one they have introduced REIT, that is for the investment properties. So they have just introduced, they didn't go much in detail for the REIT, right? So that is CC and CSC, SCC above the CSC. The trading flow is managed by CSC. If you want to purchase shares, you have to speak to one of these share brokers, right? Share brokers, we have 24 at the moment. You have to speak to one of these brokers and you can get it. It's only, everything is online. Filling the forms is online, right? Scriptless. So once you invest in, you don't get anything. You will be open account with CDS, that is CDS account. And everything will be recorded in CDS account for shares and buying, selling, everything. So we have learned two types of market, bull market and bear market. Prices going up, that is bull market. Prices stagnating and coming down, that is bear market. Also, and also we discussed additional for your knowledge purpose. It's an economic indicator of any country share market performance. And we know now recently the share market reached all share price index, ASI 9,000. Now it has come down drastically now by 2,000 points now. It has now trading at 7,200 levels. It has drastically collapsed share market. It's a high risk. The high risk, high return. So what's the compensation for the investment in share market? Is the capital gain and the dividend. So what do you mean by scrip dividend? Scrip dividend is basically dividend is paid not by the form of cash, but in the form of shares. And there we have discussed right issues. Right issue is for whom? Right issue is for existing shareholders. Right issue is for existing shareholders at a discounted price. At a discounted price. So rights are issued under the rights given to the ordinary shareholders. So there are rights available to the ordinary shareholder. I think I have not given that part to all. There are rights available for the ordinary shareholder. Now, ordinary shareholders are the true owners of the company. Now, if you purchase shares from the CSE, meaning you are purchasing ordinary shares. It can be either voting, can be either non-voting, but you are purchasing ordinary shares. So you become a real owner of this particular company. So the real owner of this particular company. So under preemptive right issues happening. So the rights are exclusively for existing shareholders. Rights are exclusively for existing shareholders at the discounted price, that meaning below the market price. So after the rights we discussed, we have theoretical ex-right price. So after the right issue, what will be the pricing? Today also we will be discussing under the corporate finance, how to raise funds through shares. And the bonus issue also we have discussed. That is also important for you to learn. And if somebody asks question now, say now, so is it worthwhile for you to issue shares rather than issue debentures? Now say now if you take your bank, now bank people, the management is asking you, is it worthwhile for us to issue shares than the debenture? You need money. You are undertaking a special project. You need money. Now they come and ask you, since you are following this course at IBSL, and what do we issue? Is it shares or debentures? So what will be your answer? Shares issue karnawada, debenture issue karnawada, make a salary hoyagan doni kila hawud. So how do you distinguish between these two? What are the advantages by issuing debentures? Debenture is a liability. One day you have to settle it. But if you issue shares, do you have a settlement kind of thing? No. There is no settlement. Think from the issuer's bank side. I am talking about your bank side. Now, settlement for the bank, is there any settlement from bank side if you issue shares? No. But if your bank issues debenture, is there a settlement after the maturity? If it is not perpetual, after the maturity, you have to settle it. You have to give back the whatever the amount to the investors. And in the meantime, you have to pay the coupon interest as well. You have a commitment. It's a liability. Shares is equity. Which one has the tax benefit? We have discussed. Remember that when we were discussing the required rate of return for a company and the cost of capital, we have discussed the calculation. Which one is costlier? Is it debenture or the equity? It's equity. Equity is costlier than the debenture. Why? The equity, you don't know how much you'll have to pay. Dividend. Because it depends on the amount you earn for the year, that is year-to-date profit or the cumulative profit. So at the AGM only you decide how much dividend per share. That is at the AGM decide. But not like share debenture, you know how much you'll have to pay for all these years until it gets mature. That is certain. Right? So sometimes you'll have to pay huge dividend for the shareholders. So they may existing at the AGM, so please pay dividend. They are earning profits. That can be happen. But which one has the tax benefit? Issuing shares or issuing debentures? When you issue debenture, have a cost. Call it financial cost, so finance cost, debenture cost, or the coupon interest. So finance cost is deducted when you arrive to profit before tax. That a simple thing, right? Profit before tax calculate all the expenses you have to deduct. So the finance cost, which is a debenture cost, interest cost, also has to be deducted. So then only you pay tax. So when you have more debt issued, you have to pay lesser tax or more tax? Lesser tax. You have to pay less tax. Why? You have expenses, more expenses. When you have more expenses, your profit becomes lower. Profit becomes lower. Then you have a tax benefit by issuing debt instrument. But think about shares. How do you pay dividend? Dividend will be paid profit after tax. If you pay huge tax, then the amount left for the real shareholders, who are the real shareholders, ordinary shareholders, dividend is quite low. The dividend is paid profit after tax. Earning per share becomes lower when you have less profit. So when you pay more taxes, So EPS becomes lower. So when EPS becomes low, you have a price earning ratio impact. Now the price earning ratio is basically calculated. How do you calculate the price earning ratio? Market value divided by EPS. Market value divided by price earning ratio is what? How low for you to recover your investment. So say you want to buy John Kill shares, market value 140. John Kill's EPS is, we say, 7. So the 20. You have this much of time for you to recover your investment. So you go for the lower one. Comparatively, you go for the lower one. You like to recover your investment quicker. Same thing we discussed. No, that is not coming under your syllabus. The project appraisal is not part of your syllabus. Now, basically, you go for now when you're doing a project appraisal, that is a payback period. Similar to payback period, price earning ratio is similar to your share market. When you invest, before you make the investment decision, you have to think about it. You have to think about the price earning ratio. How long for you to take to recover your investment by investing in shares. So financial instruments. We have learned several types of shares, ordinary shares, preference shares, and participating ordinary shares like that, redeemable shares. All those things are literal meaning. It's only a literal meaning. Nothing special in it, only the features are different. And also when we talk about government securities, we discuss price earning ratio. I'm sorry, the price and the yield. The relationship between price and the yield. The negative. So that is also you have to discuss is the important one you to understand. Now all these financial instruments we have learned. Then again we have learned under foreign exchange market. We have learned how the cross rates are calculated and how does the forward rates are calculated. Now there are two types of there are two determinants of premiums. Now, for example, today 197, so after 3 months time 190, say 200. So what is this 3 rupee? It's a premium. So how do you determine the premium? There are two determinants: purchasing power parity and interest rate parity. Keep in mind. So the purchasing power parity means inflation. Interest rate parity means two different countries' interest rate. So based on that only you determine how much the premium available. What is the premium for you? What is the discount for you? Right? And we have learned base currency and the quoted currency. Right? Base currency and the quoted currency. Quoted currency's interest rate should be above, then the base currency's interest rate has to be below the line. Then you have the figure that is. So we have learned this, the application of and also 1 plus. Remember that 1 plus the percentage and into the number of days. The last time we have discussed spot rate, and we have also discussed the cash term spot and forward. Right, the literal meanings only. And also we discussed what do you mean by nostro and vostro. You want to send money outside Sri Lanka, you need to maintain nostro relationship. Right? Then we have discussed the cross rates. How do you arrive at the cross rate? If it is direct, indirect. If it is direct, indirect, how do you discuss? Straight and multiply, cross and divide. All those things. The easy methods I have given to you for your calculation. keep in mind. And also we discuss direct and indirect quotes. That is also important. And there are 4 currencies which are available under indirect. AUD and in New Zealand dollars, Euro and GBP. Those are the indirect quotes available in the world now. And other than that, everything is starting from USD. That is direct quotes. You can keep in mind, Sri Lankan one is direct. Important, right? So then bid and ask rates, and also we discuss, and again we discuss the derivative products. So under derivative products, we have discussed internal and external. So the internal one, we are not much dealing with the internal one, which is not existent. And external ones, the ones we have discussed, that is forward exchange options, swaps, futures, and all those things, right? The important one. And the call option, under we have discussed call option. You have right, but not the obligation to buy, that is call option. You have right, but not the obligation to sell, that is put option. Right? The striking price also we discussed. Then the why the options are not popular among Sri Lankans. Why the Sri Lankans not among Sri Lankans? Because of why the option premium. Option premium is the main thing why the options are not popular among Sri Lankans. They go for forward exchange contract. And while we are discussing, and we discuss the present importation restrictions as well, and we discuss the interest rates scenario, and there are 4 types of yield curves, and the present interest rate scenario will prevail in the future as well. And what is the impact of exchange, lower regime of interest rate to the exchange rate depreciation, exchange rate appreciation. Anything you pay more, that is your country's currency is weak. Anything you pay more, your country currency is weak. So that's so always your left hand side equals 1. So all those things we have discussed, right? So you have a comprehensive knowledge on what we have. Sometimes you feel it's new to you, but it's a good opportunity for you to learn. Since you have not touched these things, it is a good opportunity. And then the pricing is your topic, but before we came into the pricing, I just wanted to discuss with you the financial assets. Otherwise, no point of discussing. And the derivative product also we discussed detail. And pricing also important for you to understand. And then we move on to the portfolio theory. Portfolio theory, basically, and yeah, before we came to the portfolio theory, we have discussed the calculation of cost of capital. Remember that? Cost of capital comprises, that is back weighted average cost of capital, comprises of cost of equity plus cost of debt. And there we have learned, remember, the systematic risk and unsystematic risk. Systematic risk is common to everybody. You can't avoid it. Unsystematic risk, yes, you can diversify. You can avoid through what? Diversification. Portfolio theory, today's topic. Portfolio theory is basically what? Diversification. So the which risk you want to eliminate? Which risk you want to eliminate? That is unsystematic risk through diversification. You don't want to worry about systematic risk. So that you can't avoid the systematic risk anyway. Systematic risk has the compensation. Systematic risk has the compensation for the calculation only. You have to give pricing. You have to give some priority in calculation when you calculate the pricing. So that's all you can do that. But an unsystematic risk, yes, you can avoid it. It's not common to you. Common to everybody. It's common to you only. Common to you only. So through diversification, you can control it. You can avoid it. Now, portfolio is basically consists of many things. Can be either debenture, can be either bonds, can be either shares, can be either different shares, anything. So basically, it's very important for you to learn. So don't put all these eggs into one basket. Remember. So then you will be in trouble. You put everything. And in this portfolio theory, we'll be learning expected return as I discussed earlier. Now, basically, before we come to this, we have touched the background. We have already learned this. Only thing we have to fine tune it. So basically, expected return is the return itself given by the instrument. Now this one. Now this one. Now see. Now different scenarios. Under different scenarios, you have different return. Now there is 9% return. The probability is 10. There is a 10% of chance you to earn 9% probability, like that. So different scenarios, different yields. So basically, this is basically the expected return. So how do you calculate the expected return under this circumstance? This is the one. How do you calculate it? Expected return. So basically, 9 into 10%, 10 into 20%, 11 into 40%, 12 into 20%, 13 into 10%. That is once you add up, that is expected return. So that is expected return. So expected return is important for you to calculate the standard deviation. What do you mean by standard deviation? So the deviation from the expected return, which we call it what? The risk. You expect now this one gives 11%. This one gives 11. Now this is another one. Now same thing. Now when you are doing questions, you get this kind of the worst case, best case, base case. So different scenarios, different rates. 14% is the expected return. Now standard deviation is what? How much presently you are earning. So now the instrument itself gives 14%. But here you are getting actually 10%. The 4% is what? The risk. So risk is calculated how? Through standard deviation. Risk is that. Risk is that. So basically, before you calculate the standard deviation, this is little technical, but I'll just give it to you. Don't worry about. Before you calculate the standard deviation, you'll have to find out the variance. So the variance is a root. Square root is the. Now, for example, take this question. Now take this question. Now the probability. Right, probability, and you have return. This is percentage. This is also percentage. So, 0.1 and 0.8. This is 0.1. This is percentage. It has converted to the decimals, right? Or either you can say 10%, or you can say 8%. You can say again 10%. Convert. And this percentage is given 35%, and it's 20%, and here 5%. So how do you find out the expected return here? Sorry about it. Now this is the question, right? It's a probability 0.1, 0.8, 0.1, meaning 10%, 80%, 10%. You convert these percentages into decimals. So then as I remove this percentage mark. And here the percentage, 35%, 20, and 5%. How do you calculate the expected return? Basically, this into this, this into this, this into this, you add these things together. Right? Here, 0.1 into 5 plus 0.8 into 20%, then you have plus 0.1 into 5%. So once you add these things, summation is you are getting 20%, right? That's been calculated for you. Same thing available in your tube as well, right? It's 20%. So then, so they are asking the risk. So risk is measured by the standard deviation. So before you calculate the risk, you have to find out the variance. That is a business mathematics, right? So then you can easily do this. I'll erase this. So how do you find out the variance? So the variance is finding out this. The variance, right? So the first one, 0.1 into 35%, that we know, 35% yield minus 20, and to the power, and again you add it, this one 0.8, 0.8, here the 20%, right? 20% minus here the 20%. Why this one to take? Here. To the power. Then again, right? Since you can't see this, 0.1% into here you have 5% into minus 20% is the mean or expected return. Then the answer is the variance. So the answer is variance. So standard deviation. I'll erase this one, right? You don't need furthermore. This is the variance. So in your tube, the variance part is not there. But once you get the answer, standard deviation, say now for example, we say we got 50. So then the 50 root is the standard deviation. So there is, the meaning is of, say, the answer is 5%. There is a 5% chance of deviation from the expected. That's the reason. So the answer is not necessary, but understand the interpretation. 5% risk is standard deviation, means there is a 5% of chance deviation from the expected return. That's what you learn to learn. There is a chance of deviation from the return. only thing you have to keep in mind the expected return, the calculation of expected return and the standard deviation. How do you find out the standard deviation for particular stocks? There is a chance of deviating expected return this much. That's the interpretation, right? And I need to do some important questions with regard to this. We can do it later, right? So that's how you calculate it. And straight away you can't calculate it, but only thing you have to calculate the standard deviation in this, right? You can read these things, but understand the expected return of the portfolio is this much, and the actual return is this much, and what is the standard deviation, which is risk, which is the measurement of risk, and what's the percentage of deviation from the expected return is important. So why do we need this? Why do we want to find out the risk of particular portfolio? So you have two types of portfolio. You have two types of assets. Then you have to decide which one you go for. Basically, you go for the lower one. So you go for the lower deviation one. Lower deviation one, the lower standard deviation figure one, right? Similarly, when you select a share, you go for price earning ratio. If you are given a price earning ratio, P ratio, select the lower one. Similar, right? And I just want to do some. You can read this, right? This one. Now, systematic and unsystematic risk. Now, basically, here you are diversifying what? Unsystematic risk. So, how do you compensate to the systematic risk in a portfolio? So, the portfolio, you are exposed to unsystematic risk or not? Yes, of course, you are exposed to systematic risk. So, how do you avoid it? So, what is the compensation for the unsystematic risk, systematic risk? So the systematic risk is basically can you remember this? What is this? This is capping. Capital asset pricing model. What is this? This is the measurement of unsystematic risk. So all these things we have discussed on unsystematic risk, which is diversifiable. Through diversification, unsystematic risk can be avoided. Different probable scenarios, different yields possible. 10% chance of earning 9%, 20% chance of earning 10%, probable. So then you go for one thing. to deviate or segregate among these things. Now here, unsystematic risk you can't avoid. So then give us a systematic risk you can't avoid it. So then give us a price for this. So that's why when you calculate, this is required rate of return. This is discounting factor. Required rate of return of a particular individual or a company. So then for that we need a compensation. Now similar example. Now see, when you calculate, when you want to real interest rate, remember real interest rate plus inflation. What is that? Risk-free rate, which is treasury bill rate. Real interest rate plus inflation. So the treasury bill rate is after adjusting the inflation. So how do you convert treasury bill rate into the treasury bond rate? Only at what? Maturity risk premium. Maturity risk premium you add to this. Similarly, you need a compensation for which is unavoidable, common to everything. So you need, as an investor, you need kind of compensation. For longer term, here short term 3, 6, 12 finish, but you are keeping for 5 years. You don't know what will happen. Even the government issuance, you don't know. Then you give us at least a premium. At least a premium. So we call it maturity risk. That's why you have yield is more than the treasury bill rate. Bond yields are more than the treasury bill rate. The difference is the maturity risk premium. We say government security does not have risk, but due to the maturity, it's taking longer. You are charged a premium. Similar to this. You charge a premium, maturity risk premium, or you can say maturity mismatch, whatever. If you don't want to say it's risk, there is no risk, but you can say it's a maturity or whatever. So what I want to show it to you is, since we have learned this previously, systematic risk should have given a compensation. That is important. Should have given a compensation for the calculation, right? So there are some few questions we need to do on the portfolio holding period return, and we have discussed business risk and financial risk as well, right? This is another type. We already discussed that. All right, this one. They have not uploaded this one. So what I can do is I will read it to you. At the moment, you don't have to write it down. You can later watch the video and write it down. Now here, holding period return. I straight away take some questions, then we can understand easily. Now this is the question. Now see this question, right? If an investment earns a return of 1% during 20-day holding period. If an investment earns a return of 1% during a 20-day holding period, what is the annualized holding period return? When you're having a portfolio with you, entire portfolio you earn here, as per the question, earns a return of 1%. But what's the time period? Only for 20. Now say you have several assets, you have several shares, but you are holding only for 20 days. You have sold it. You have a different asset, whatever the assets, whatever the shares you have in your portfolio, but you have sold them after 20 days. Only 20 days. But they are asking, what is the annualized holding period return? What is the annualized holding? So if you take 20 days, you have earned this much. But what if you take annualize it? If you take annualize it, how low? What is the annual return? So how do you calculate? This is the formula for you to calculate. If an investment earns a return of 1% for 20 days, 20-day holding period, what is the annualized holding? So basically annualized holding period, the annual period, annual return. So the formula is this one, 1 plus holding period return. 1 plus holding period return. And 365 divided by n. Keep in mind. Right? 365 divided by n. So 1 plus holding period return here, the 1%. 1% is 20 days. So 365 divided by 20 and minus 1 here something minus 1. So this is your answer. Annualized holding period return. Annualized holding period return. $365 divided by 20, 1825. So 1.01 the power 18.25 minus 1 comes 19.9. This is the annual return. But your portfolio, you say, I have hold the period of 1%. I only earn 1%. But actually, if you annualize it, it comes 19.9%. Now say, this is the second question. If an investor earns a return 1.2% during the 5 weeks, here the days, we take 5 weeks. How do you do this? Same thing. Only this changes. If it is week, it's very important, right? Weeks, how many weeks do you have per year? 52 weeks. Then divided by number of weeks. 52 divided by, in this particular question, I'll be not taking with your number of weeks total available and week. So that's the week. The week question. And the next question. If an investor earns a return 2% during the 2-month holding period, what is the annualized holding period return? 2 months. If it is 2 months, this only changes. 12 divided by n. 2 months, now 2 months, you put it 2 months. Instead of 2 months. That's all. So the formula is n. That's all. If an investment earns a return of 200% during a 5-year, during the 5-year period, what is the annualized? Now see, all these times we have learned days, weeks, and months. Everything less than 1 year. Now here, see, if an investor earns a return of 200% during a 5-year period, how you earn 200%? And what is the annualized period? What is the annualized period? So how do you find out that? That's slightly different. Invest 200% during a 5-year period. What is the annualized? What is the annualized 200% during the 5-year period? During the 5-year period, what is the annualized holding period return? So if it is 5 years, 1 divided by 5. 1 divided by 5 minus 1. Always there. So see, if it is more than 1 year, this is the formula for you to calculate. 1 divided by, instead of n, 5 is 5 as the example, but it should be 1 divided by n to the power. 1 divided by n to the power. This is power, right? I just make it a little bigger for you to show it, but it should be 1 divided by n minus 1. This is the holding period return of your portfolio. Holding period return. Very good questions, right? Annualize. Days, weeks, month, and years. Everything is covered. Annualized return can be tested. Holding period return of your portfolio. Holding period return of your portfolio. So you keep in mind the different formulas. If it is week, you have 52 divided by whatever the n. If it is month, 12 divided by whatever the n. If it is week, days, then the 365 divided by 20, or 365 divided by, here the 20, the n. Annualized. Only thing you have to keep in mind that years, it should be 1 divided by n. Always 1 divided by n minus 1. So that's the portfolio holding period return. I wanted to give it you those questions. Good question. The holding period return on a security is 6.5, for example. If the holding period is 1 month, the annualized holding period return is all those questions. But if you know this particular formula, you can apply anything. So question, answering the question is not vital, but understand the logic. That's all. And see this question now. Lanka Oil Company common stock has earned following returns. Lanka Oil Company stock has earned the following returns in the past 5 years. Year 1, rate of return 30%. Year 2, rate of return 10%. Year 3, rate of return 0.5%, minus 5%. Year 4, 4%. 5, minus 12%. They are asking the standard deviation of the return of Lanka Oil stock is. So you can't straight away calculate. So how do you calculate it? Shall we attempt this question? This is new to us, right? It has not uploaded this question. I'll read it to you, then you can later watch and now it says this. You can see this, right? This is year, and this is rate of return. Rate of return. Year 1, 2, 3, 4, 5. And here you have 30% rate of return. Here you have 10% rate of return. Here you have minus 5% rate of return, and here you have 40%, and here you have 12%. So the examiner asking you what is the standard, what is the risk, so what is standard deviation, how do you calculate it? So first you have to find out the expected return. How do you find out the expected return? Question like this. So then you have 30, then 40, 80, then you have 17. So 63. 63 is the summation of these. Here minus, 30, 10, minus 5, 40, minus 12. Can be possible, right? This is the portfolio. Lanka Oil Company common stock. This is your portfolio. And divided by how much? 5. So 63 divided by 5. That is the mean. You're finding the mean. Divided by 5. It's 12.6. 12.6. So then how do you calculate then? Then you find out the variance. So 30 minus 12.6. And again you have 10 minus 12.6. Then you have minus 5 plus you have minus 5 minus 12.6. Then plus you have 40 minus 12.6. Then again you have 12 minus 12 minus 2.12.6. This is your covariance, and to the power. And the answer, what you can answer, the square root is your what? Standard deviation. That is how you calculate. You don't want to have the probability of all these times, right? You can have a question like this as well. Portfolio return of different years for a particular company, particular stock. So you can have that as well. So and formula is also given to you to calculate or it's available for you the formula also. Here is one. Standard deviation, finding out the standard deviation. Right. So right. So basically, understand the important thing is why we are learning portfolio theory, because of diversification of portfolio. So which one is diversified? Unsystematic risk. So this is how you calculate the portfolio management. Portfolio expect the return and the deviation from the expected return, right? Right, and also there are market risk. Now that is one of the part of your syllabus as well. The discussing the market risk. Market risk. There are 4 types of market risk available. Market risk. There are 4 types of market risk available. So these are the 4 market risk: interest rate risk, equity risk, interest rate risk, equity risk, and foreign exchange and commodity risk. So all these things risks we have discussed with you all. All these things risk we have discussed. Now all these diversification portfolio involves interest rate risk, all this portfolio involves all these market risk, interest rate risk, and foreign exchange risk. Relevant, this is not relevant foreign exchange risk here. Interest rate risk, commodity risk, equity risk, all these risks are involved in this case. That this is 1, 2, 3, 4, 5 years. These are the return. Now, return can be minus as well, particular one. Yeah, but it doesn't matter. You find out the mean, which is expected return, right? Expected return. So the how much the expected return, the variation, covariance. Find out. This is how you do this. And once you add these things, everything together, to the power, then, and you have the answer you have here. This is the root of, this is the answer you should n minus 1, right? Divided by n minus 1. Then you have the root of loss, that is your standard deviation. So that's the risk. So how much the percentage of deviation from the expected return? This is expected return, which is mean. Right. So all those market risk, interest rate risk, foreign exchange risk, equity risk, and commodity risk. Interest risk is anyway there. How does the portfolio impacted to interest rate risk? Now, these are the investment in shares. For example, there is no government security. For example, we say, how does the interest rate risk exposing? How does the impact of interest rate risk to this? Is there any direct impact to interest rate risk of this portfolio? Which this portfolio consists of only the shares. Example, there is no government security or debenture, whatever the fixed income security. So how does the interest rate risk impacted to this? Does this have any impact? Yes. Interest rate risk. What happened? When you have interest rate risk, means what? Interest rate is going up or coming down. When the interest rate, when the interest is going up in the country, does it impact to the share market? Of course. When the interest rate is going down, is there any impact to the share market, the share investment? Of course. There will be a price appreciation. There will be a price appreciation, or there will be a price depreciation depending on the interest rate. There is an indirect impact. There is an indirect impact of interest rate decrease and increase to the share market. That is now present days. The market now low regime of interest rate. Now, when you have a low regime of interest rate in a country, the share market, which is a risky asset, has to go up. That's what actually we have seen recently, but suddenly it has come down. Even at a low regime of interest rate, why the share market in Sri Lanka has come down? That's a different reason. That's it. But fundamentally, theoretically, when you have a low regime of interest rate, share market should perform well. It has to be a bull market. But there is no sustainability in Sri Lanka. There is no sustainability. Why the sustainability doesn't exist? So our market is mainly depending on the foreigners. Foreigners are exiting. They are pulling out their investments anyway. So there is no foreign investment, new foreign investment. The market is going down. Now there is no forex directly, but indirectly, yes. When the foreigners come into market, then the prices tend to go up. There will be appreciation of this pricing. When the price getting appreciated, the yield also should go up. Equity risk, anyways, there is a direct impact. Equity risk. Prices going up, prices going down. But the prices going up, prices going down depend on these two. Understand? Depend these two. Commodity market, of course, there is no impact. There is separate commodity risk. It's commodity risk. There is, for example, gold pricing and all. Now, commodity market has direct impact to the currency market. Commodity market has direct impact. Example, now when the gold pricing going up, dollar is getting weaker. When the gold pricing going up, when the oil pricing going up, dollar is getting weaker. Like that. There is not in Sri Lanka, but commodity market is not available much in Sri Lanka. But other countries, of course, you have market line, right? So the understand that there are 4 types of market risk. These are the 4. Now, efficient market funding, this is another term you need to learn. This is basically expected return and the risk. Expected return and the risk. So basically, you have a good portfolio here, only inside of this curve. Inside of this curve, then you have. So if you can plot your portfolio inside this expected return and the risk, you are plotting it expected return a particular stock. If it is coming here, so those are the stocks we say it's efficiently performed. Good one, right? Good one. So that is another one. Yeah, CML also the similar one. Capital market line. It explains here, right? Now, when you're going for a financial institution, these are the risks available to you. We have all these risks we have learned. So I will not taking one by one. You know these things. What do you mean by sovereign risk? Country risk. Sovereign risk means country risk. Now we have country risk. Now when the rating agencies downgrade Sri Lanka, we have a sovereign risk. So basically, sovereign risk is available. Now, who are the people mostly worried about the sovereign risk? People who have invested in Sri Lanka. People who have invested in Sri Lankan instruments. Example, ISB, international sovereign bonds. So they are highly worried about whether Sri Lanka will honor it, whether they will pay it. So the sovereign risk is anyway there. So that is another risk. And remember, when you are doing foreign exchange transaction with you, we have learned 3 types of risk: transaction, translation, and economic risk. Remember that we did it. So the economic risk is kind of part of the country risk. Right? You have investment there, then government has put a restriction to remit dividend problem, country risk. So to compensate for that. Off balance sheet risk. Off balance sheet, same one. Right? So risk mitigating factors, you can do this, only the theory part. Now, sourcing of financing also we have somewhat we have touched. So this is not new to you. How do you get funding? Now we have discussed. You are working in a bank or a financial institution. What are the methods you are applying? What are the methods you are applying to get funding? So one thing is depositors' money. So depositors are the key for you to get funding, apart from the owner. For the depositors' money are not enough. So how do you get the funding if the owners are not willing to give you? How do you get the funding? There are methods. Internal source of funding. What do you mean by internal financing? Internal financing means retained profit, nothing else. Internal finance means retained profit, nothing else. So if you are keeping your money If you are keeping the internal profit without paying dividend, I don't know it's possible or not. You have to think about it. It's possible. Internal source. If you are not paying dividend for your shareholders, you can save internal funds. You can save internal funds. You can save internal funds. How do you save internal funds? By not paying the dividend. Now say, now in your company, now when a company, if you take a company, how does the balance sheet appear? Now here, this is the balance sheet, right? Typical balance sheet. Share capital, then you have a reserve. Under reserve, you have accumulated profit. Then you have other reserves as well. Now here you have 1,000. Here you have 500. Other reserve you have 200. So altogether you have 1,700. When you're making losses, what happens? This goes off. Now we say we don't have any other reserve. Here only 1,500. Next year loss 500. No cumulative loss. Year to date profit and give out the profitability for 500, may out the loss 500 equal 0. No profit, no loss. Next year comes, you're making a loss, 1,200 loss. Loss. So what is the net worth? Minus. Net worth is minus. Do you have anything internal source of funding? No, you don't have. What do? You go for the external borrowings for you to do the business. So when you go for the external borrowings, what happens? You further put into the trouble. The further you go into the trouble. Why? You're making losses, but you have externally you have funded. Again, you have to make the payment. No point of doing this. You are in trouble. So the capital restructuring has to be done. So the loss-making companies. So internal source of funds are available only the profit-making ventures. Only the profit-making ventures. So other than that, internal source of fundings are not available. What are the other external source of funding? One thing is we have learned share market. The share issue. We have learned this. IPO, we have learned this. Private placement, we have learned this. Debenture issue, we have learned this. Those are the external. Generally, companies are going for external sources as well. Due to various reasons. Now, for example, as I asked you the earlier question, why do you want to go for equity rather than going for a debt? It's up to you to decide. Do you pay dividend or do you pay coupon? Are you taking by issuing debenture tax advantage, or if you don't want to take that tax advantage? Some companies don't like to go for borrowing, but the borrowings are somewhat good. ණය ගන්න එක හොඳ නැද්ද? හොඳයි. හැබැයි you should keep a limit. Where is your limit? How do you find out the threshold limit? What's the ratio you have learned? What's the ratio you have learned not to go for excessive borrowing. Debt equity ratio, gearing ratio. How much you have debt compared to the equity? Debt equity ratio. Excessive borrowing, not good. You will be in trouble with, what's the risk you are facing then? Financial risk. Where do you reflect the financial risk? Balance sheet. Debt equity ratio. So then how do you find out the external source of funding? One thing is share issue. But some companies don't like go for share issue. Why? Main reason why you don't like to go for share issue. Tell me why. The main reason why you're not issuing shares. What's the fear you have? To get the funding externally, you have not decided to go for share issue. Why? What's the main reason not to go for share issue? The main reason is can anybody say now there are 3 people online? Can anybody say that this is today's my last lecture? Can anybody say that why you are not decided? What is the fear you have not to go for share issue?
Dilution of the ownership.
Very good. Very good, Gayan. That's the answer. So you are fear of dilution of your ownership. You don't want to dilute your ownership. That's the answer. You don't want to give somebody your control is why you are giving to somebody. You don't want to give. So the main reason why you not go for share issue, as very correctly Gayan said, dilution of ownership. You don't know. Plus, there are some additional benefits available if you go for borrowing. Main thing is tax benefit. You can't avoid it, tax benefit. Anyway, you have a tax benefit. That is the one reason you encourage to go for borrowings, go for debt securities, go for debt issuance. Right? One thing is you don't want to dilute your share ownership, then you go for borrowing, share issue, debt issue. The other one is tax advantage you have. And also you have more convenient rather than going for a share issue. It's easy, comparatively, right? Comparatively easy. Both are cumbersome, but comparatively, it's easy for you to go for debt issue rather than issuing shares. Right? And so when you issue shares now share market, there are a lot of companies under threat for the acquisition of another company. There are 2 types of acquisition: hostile and friendly. Now acquisition also, form of acquisition also 2 types. One is merger, the other one is acquire, the control stake. Merger is good. You get together, you just discuss both the companies, you get together. Acquisition means both the companies are existing, you take the controlling power of the acquiree. Sometimes acquiree doesn't like it, but can't help. Through direct or indirect holding, you acquire it. So you don't know, you become a hostile acquiree. You become a subsidiary of another company. So you become a sister company of another company which is controlled by another company. The controlling is, you are losing your controlling stake. It can be either direct, it can be either indirect. So the ones you add together, your holding percentage comes. It has happened, right? It has happened. It's happening. But there are defensive mechanisms available for you pre and post. Pre and post defensive mechanisms are available for you not being a victim of another company's acquisition. There are, but those are not much practical. Only the theory are available. You must have heard this poison pill and all this board of directors composition, spin-off and all those things. There are, but those are not that much practical. Can't do that. So there is a risk of being acquired by another company if you put into the shares into the market or whatever, somebody else's, right? So that is the main source. Now, main source of finding finance is for your company is share issue. If you don't want to go for borrowing, share issue. And internally, what else you have? Then the right issue. Then the right issue you have. Right issue also another method of finding capital. Now, shall we attempt this question on the right issue? This is the question. As part of Basel III requirement, this is the question that I'm reading to you. CTB Bank decided to raise 1,000 million equity through right issue of voting shares at right price of 200. Right price 200. So the right price is 200 means what? Right is for whom? Existing shareholders at a discounted price compared to the market price, lower price. So the right issue price is here 200. The rights will be allocated to the existing shareholders that we know at the ratio of 2:1. One within bracket it says one right for every 2 shares. The current market price of CTB Bank share is 350. Current market price is 350, but the right issue price is 200. Correct. Below the market, why you are giving it to the existing shareholder? Our question is asking, compute the X right price. X right price is, remember, after the right issue, what's the price? So this is how you calculate. Now, this is very common calculation, right? In the share market also. Practically also we are using this. What is the right issue percentage? 2:1. 2:1. So always new shares are less. New shares one new existing 2. දෙකක් තිබ්බොත් එකක් දෙනවා. 50 තිබ්බොත් how much? I have 50 shares. So what is my entitlement? 25. Like that. And if you don't subscribe, again you are losing your control. I think we have discussed in the class. So the right issue price is how much? It's 200. What's the present market price? It's 350. Now, generally, the right issue prices should be more than the market price or less than the market price. It should be less than. Why? How many new? Then 3. You have more supply. So the 2 is into 30, 350, it's 700. 1 into 200 is 200. Its total is 900. Divided by 3. Why 3? 2 plus 1. The ultimately after right issue, you have 3. So the divided by 300. So the answer is 300. This is your theoretical X right price. After the right issue, shares will be traded shares will be traded at 300 rupees per share. What's the present price? 350. Why you have price reduction? You have more number of shares into the market. Earlier you had 2, now with the right issue you have 3. Additionally 1, so the entire thing is 3. So the more supply price, when you have more supply, prices decrease. So that's the share issue price, right? TPC PLC, a listed company, is looking at various sources of financing. This is one of the methods of financing, external, available to fund one of their future projects. Management and the board of directors decided the best method of financing the project is through a right issue. Company is confident that the rights issue will be fully subscribed. Given the track record of the company on the now. TPC is currently trading at 50 rupees. Current market price is 50. And tomorrow is the X-right date. Without right. X-right means without right. Without dividend, X-div. X-right. For the calculation, you have to always take the X-right or X-div. Right side showed at 40 rupees. Market is at 50. The ratio and at the ratio of 1 right for every 5 shares. 1 right for every 5 shares. So 1 right. So every 5. 1 right. What is the right price? Rights are issued at 40. Existing price is 50. So the question is outline. Now here there are 2 questions. Outline 2 advantages of right issue as a source of finance. As you correctly said, advantage, you don't lose your shareholding percentage, and you are giving a special special attention to the existing shareholders by issuing rights. Your existing shareholders can be participated at the rights. So the second question they are asking, based on the information provided, calculate the theoretical expected share price after the right issue. So this is here the 40 and here the 250. Total is 290. So divided by how much? 6. So 290 divided by 6. So how is it finding? 48 point something. One right for every 5 shares held. 1 right. So the right issue price is these are currently trading at 50, and tomorrow X right date rights are issued at 40. Rights are issued at 40. One right thing 40. Existing for 5 shares held. Current trading at 50. I don't know why the examiner has given odd number. Now this is the question. I have taken this question recent now 2 weeks ago. Investment banking examination January 2021. Now recently concluded 2 weeks ago concluded examination paper. So that's the question. So 5-mark question there. There are 2 parts of question, and this kind of question now. See, 48 points on. This is how you do this. The earlier question I have taken from the same investment banking question paper 2018 March. So this is one of the method of sourcing funding, the projects and all those things, right? So these you can read it. These are the things you can. Now, what do you mean by venture capital? Now, venture capital are the companies you need capital, but you have idea, but you don't have capital. Now, venture capital companies, to promote the venture capital companies, government not recently. So during the previous government, they have introduced a separate board, Empower Board. That is to improve the venture capital companies, SME sector, right? MCB board. This I can read it. Now see, this is the method of issuing shares. Placing means private placement. Huh? Public offer means IPO. Share option means what? Option. Share option. ESOP. Employee share option. Employees are given. Now, when a company is going to be privatized, especially the the government companies, before you get privatized, you give this to the portion of the shares to the employees as well. Now, and these are the rights of equity shareholders. Now, under preemptive, now see this one. Under preemptive rights only, they issue rights. Before you issue something to the outside, you first issue to the existing shareholders. You issue to the existing shareholders. Now, what do you mean by this market capitalization? What do you mean by market capitalization? It's a term we use to measure the share market performance, kind of performance, market capitalization. So basically, when you have more market capitalization, it's better. Number of shares issued into the market price, that is market capitalization. So you have highest market capitalization when you issue more shares, plus when your share prices go up, you have more market capitalization. When you have more market capitalization, so it's better you have more market capitalization. It's good for the country as well. Do you have any question? If you have any question, I can answer. We have discussed the malpractices of share market, right? We have discussed that when you are dealing with the share market. Remember that front running, insider dealing. Front running, insider dealing. Pump and dump. Those are the malpractices happen through the share market when you're dealing with the share market. So now actually share market now it's basically controlled now at the moment. Control in the sense more stringent regulations are imposed. Now you know recently share market reaches 9,000 ASI, all share price index. Now it suddenly came down. Why it has come down? Now basically you know nothing, there is no any reason. There is no any reason to come down. Geneva වල තියෙන human rights ඒක අපි පරදී කියලා ඒකට මොනවාරි දෙයක් ඉතින් අල්ල ගන්නවා. There is no any reason for that. Why? So basically the reason is that CSE has issued a circular to report the credits weekly. Now earlier the credits are reported fortnight, twice a month. Now they have requested credit to be produced weekly. So the suddenly collapse. So the people tend to, so the brokers tend to do forced selling. Forced selling is what? So if you have now generally you have to settle the shares purchase or sales spot date. Day after tomorrow you have to settle it. See, I have purchased shares, but I have not made the payment. I have not made the payment to whom? To the broker. Broker negani on behalf of me. You have engaged with the broker. You deal with the broker. Even you purchase shares from somebody, it goes through broker. So the broker has to make the settlement. Similarly, securitization papers with money. Remember that? We have not done that. But securitization is also the similar. Toyota වලින් වාහනයක් ගන්න ගියාම leasing company එකපාර ගෙවනවා Toyota එකට. But ඔයා leasing company එකට ගෙවන්නේ installment basis. For 60 installment, 5-year leasing. But Toyota එකට leasing company ගෙවනවා. There is a mismatch, maturity mismatch. Cash outflow එකපාර යනවා ගොඩක්, but the inflow is coming slowly. Leasing company එකට සල්ලි නැහැ business කරන්න. So then they have introduced a new instrument called securitization. මොකද කරන්නේ? CR leasing ගත්තාම CR books CR එක තියෙන කාය ළඟද certificate of registration තියෙන කාය ළඟද leasing company. Absolute ownership is with you, but only thing the leasing company is the owner. ඒක යා විකුණනවා. For the securitization, if the structure is securitization paper, they sell it to somebody. Sell it to in the sense, so they sell it to me means I provide funds, but you have to give me the CR to me. ACR to Mangano. Certificate of registration to Mangano. So, but you don't know, but you are actually making the payment to the leasing company only. Similarly, you get the money. So it's very securitization papers are very much popular now, finding out the funds. So practices also happen in the share market those days, but it's not happening now. There is no pump dump happening at the moment, but there are few occasions we have seen, but very difficult. So that's why they have put some more stringent controls. So that when you put more controls, difficult to survive the market. Basically, we also understand that you should allow the credit to work. Almost all the shares ගන්න. So ඉතින් දැන් උදාහරණයක් සමහර shares දැන් මේ වැටෙන කාලේ වුණත් ගත්තා නම් සමහර shares තියෙනවා ඒක you can sell it without having any cash outflow. Same opportunities you have. But if everybody is going to do the same thing, so there is no end. That's ගන්නවා මේක රුපියලකින් උඩයයි කියලා මොකක්ද ගන්නවා everybody is asking, but we don't have money, but we are purchasing. Everything is going on credit. So that's why actually it has come to an kind of collapse. That's reached 2000 and the best performing share market once recent time. Best performing share market. That's collapse like nothing. So then when you collapse, so the confidence you have in the investors losing. You don't have any confidence to invest. You don't have any confidence to invest. So the people actually moving now. You know, in the share market, every day you can see foreign net outflow. So the players are the retail locals. There are some institutions, local institutions. There are some foreign buyers as well, but net foreign selling. So when you have net foreign selling, it has directly impact to the foreign exchange rate as well. And people are moving, and the investors are taking their money. So they need dollars. Additional pressure on the exchange. So these are the rights, of course, a shareholder has. So on the preemptive rights only we have issued. The share market, the preference shares means what? This is similar types of shares, but not we are treating as ordinary shares. But this is kind of borrowings. This is shares, but we are not treating as a shareholders of these preference shareholders. So one day you will have to settle it, and you have to make the dividend as well. Preference shares very similar to shares, but not shares. These are the types of shares we discussed. These are the types of shares available at the moment. Preference share capital, you can read it. Debt capital, actually we have done this with you all. Fixed and floating. Fixed rate is what? It's fixed for tenor. Floating means changes every 6 months or whatever the time period. Generally, we go for 6 month trending by the 6 month treasury bill rate. Debentures are issued at floating or fixed. It depends on your requirement as well, right? So we have discussed the previous days why you want to go for fixed, why you want to go for floating, depending on what yield curve and the interest rate, future interest rate scenario and all. Now, debt capital also we have just today early part of the discussion we discussed convertible debentures and callable debentures and Basel III requirement debentures. And also remember that I wanted to tell you that this Basel III required the compliant debentures can be invested only for qualified investors. Qualified investors are the funds only can be allowed to invest. An individual also can be invested, can participate at the debenture issuance, 81 or the Basel III compliant, provided they have 50 million more than investment. Otherwise, individual can't go for that. Why? Depending on the feature, depending on the features, you are not allowed to do that. Only qualified investors are allowed to invest in these kind of instruments presently, right? These are the debt capital available for you. Only the literal meaning. We have done everything in this case. Corporate bonds, we have done term loans that you know, debentures we have done, leasing, convertible. What do you mean by warrants? Warrants, we call it a sweetener. Warrants is the sweetener for you to encourage purchase shares. Now, for example, now if you buy shares now, ඒකට දෙනවා ස්වීට්නර් එකක්. ඒ කියන්නේ පොඩි අයිසිං එකක් දෙනවා. අවුරුදු 3කට පස්සේ ඔයාට තව ඇඩිෂනල් ටිකක් දෙනවා විකුණ ගන්න පුළුවන්. ඒ වගේ ස්වීට්නර් එකක් දෙනවා. තව ඇඩිෂනල් මොනවා හරි ඔයාට එන්කරේජ්මන්ට් එකක් දෙනවා for you to sell. Mezzanine finance means the secondary market subordinate bond finance. Securitization, it is not coming under your syllabus, but we have just discussed the leasing matter. Project finance, loan syndication. If you can't give if your bank can't give the loan to one particular customer, it's a big amount. So then you get together and give. Very common in the international market, sovereign bond issuance and raising funds from overseas. Very common subject. Loan syndication. You get together, one or two, three people get together and you give. Bridging finance means before you approve, that's you know it's a credit term. Before you finalize the facility, you give some facility to entertain this customer. The bridging facility. Purchase at the moment it's not available too much. And these things also we discuss. Remember the convertible option, callable option, puttable option. The first two are very important. Convertible debenture, you convert into equity. Who has the right? Holder has the right. Callable option, who has the right? Issuer has the right. So important to note that. Issuer has the right. So generally we have previously issued subordinate debentures, right? Subordinate debentures are allowed to take into the capital. Now you can't now take into the capital. Why? Due to the present Basel III requirement, you are not allowed to take into the capital subordinate debentures, but it has to be convertible debentures if you want to take into the capital. For bank point of view, right? So Basel III compliant debentures. Has to be convertible option has to be there. Before it's get matured, you convert into equity. And also remember the 81 instrument which we discussed. Now all these debentures are unsecured. You must have seen if you are working in a bank and see your recent debenture issue, all unsecured. There is no secure debentures. Previous unsecured anyway. Guaranteed debentures are there, but the guaranteed debentures, recently I have seen this type of debenture, but only the interest rate is guaranteed. Now recently I can remember, not recently, some time ago, Ceylon Bank issued a debenture, but the Sampath Bank guaranteed the coupon interest. And recently also I have seen some commercial credit to they issue debenture, HNB or somebody guaranteed the coupon interest, not the principal amount, only the coupon. It can happen. Now these things come instead of what? Underwriting. Now see, if you put an underwriter there, it basically you give a bad impression to the third party. So what are sure na make a subscribe karai kela මිනිස්සු. ඒතකොට මොකද කරන්නේ underwriter කෙනෙක්ව appoint කරගන්නවා. underwriter කෙනෙක්ව appoint කරගත්ත කියලා මිනිස්සු දැනගත්තාම මිනිස්සුත් හිතනවා අපෝ මේ කම්පැනි එක මේක subscribe වෙයි කියලා sure එකක් නැහැ. ඒකෙන්ද why should we invest? So to avoid this, underwriters are not available at the moment for a new debenture issue. We have not seen that underwriters. Subordinate debentures, it's subordinated only to the capital. Subordinated only to the capital. So when the company is going to be liquidated, අන්තිමටම ගෙවන්නේ කාටද? අයිතිකාරයන්ට. අයිතිකාරයන්ට ඉස්සෙල්ලා ගෙවන කෙනා තමයි මෙයා. ඉතුරු වෙලා තිබුණා. මොනවා හරි සල්ලියක් ඉතුරුලා තිබුණොත් අන්තිමට හම්බෙන්නේ අයිතිකාරයන්ටනේ. හැබැයි අයිතිකාරයන් ඉස්සෙල්ලා මෙයාට ගෙවනවා. ඒතකොට this is more like capital. ඒක තමයි ඒක capital එකට ගන්න allow කරලා තියෙන්නේ. debenture වුණාට allow කරලා තියෙන්නේ සල්ලි capital එක විදියට ගන්න. අන්නේ feature එකකින්. subordinated debenture subordinated only to the share capital. මොනවා සල්ලි වගේ ගෙතුනම මෙයාට තමයි අර common shareholders ලාට ගෙවනට ඉස්සෙල්ලා මෙයාට ගෙවනවා. හැබැයි අර ඉතුරු වෙන්න මොනවා ඊට ගෙවලා ඉතුරු වෙලා ආවොත් තමයි debentures with embedded options. Debentures with embedded option means what? Convertible or callable option. They have it. What do you mean by junk bond? Junk bond are the bonds which are trading at higher yield. Now sometimes our ISBs are junk category. Some can say ISB international sovereign bonds are at junk bond category. That's what people say. Convertible debenture and callable debenture are the two options available for debentures. That is embedded options. That is embedded option. They are available. Corporate bonds are very similar to the debenture, or the name is changed. There is no any other difference between these two, right? And debt finance, you have advantages. We have discussed these advantages compared to the debt finance and the equity finance. Same thing available here. Same thing, right? Retained earnings are the internal source of funds. Scrip dividend we have discussed. That is, the dividend is paid in terms of shares instead of cash. So finally, disadvantages and advantages of what you have seen, and the types of financial risk. We have discussed this risk as well. Credit risk we have discussed, default risk we have discussed, liquidity risk. Yes, if there is no liquidity, you can sell it at a loss. Debenture treasury bill ගත්තා, but ඔයාලට sell කරන්න ඕනේ මම මිනිස්සු නෑ ගන්න. Liquidity risk. Foreign investment risk. Equity risk. Currency risk. Currency risk are the foreign exchange risk. Same thing. That is same thing. And financial risk and business risk and other types of risk. This is part of your syllabus. What's the other category we have learned? Systematic and unsystematic risk. So the finally business risk. This is actually theory part. I have taken. It comprises the business risk comprises of these things. Business risk basically is your profitability is going down. That is your business risk. It can say anything, but the nutshell is business risk is that. Where does it reflect? The P&L or the income statement. So business risk is so. These are the risks available, business risk and risk. So that's it. Any question you have before we wind up? So today is the last day of mine under this financial market. I have given a few topics to complete with your Mr. Purachidaran, with Mr. Purachidaran. Mr. Purachidaran has done other parts with you all, I think. So I have given to complete this part. So I wanted to give you kind of a knowledge for you all, rather than facing for exam or whatever. So don't worry about the questions. You can pass this. Don't worry about. But only thing, at least if you have learned something, the discussion we had. Only thing, it's a one-way discussion, right? It's only me talking. There are a few students who spoke this today and the previous days as well. Thank you very much for their participation, and others also. Thank you very much for their participation. Please go through whatever we have done, and whatever the question will be based on the notes available to you only, right? We have many things discussed, but I request you to have a kind of knowledge what's happening around. For example, the impact of the exchange rate, importation restrictions, and it's not available in your notes. But you as a banker, or you are working in a financial environment, you should have a kind of knowledge on that. You should know what's happening. You are in the financial market. It's a very vast market, and you are privileged to have this market, the member of the market, financial market. Right? We, Sri Lanka, is small in terms of size, but you must be proud of being a financial market member, right? So we have basically I have concluded the task I have been given to me, and hopefully that you must also have kind of knowledge. During these 5 days we had discussion with you all. So in a very difficult time. So 150, 130 is very difficult. So we have decided not to give any breaks as well. It's basically losing your data only. No point of it. Is you are at home. Why do you need any breaks? No need. So I need a break, but I don't want to take it. So I'm talking. So from 1:30 onwards, right? Difficult task, but it's privilege for me. So it is more. What you call efficient, yeah, than talk. It's understood that it's very difficult for you as well, sitting in one place. So you must have a kind of, you can have movement. I can't see you all, but you can see me. I can make such movements, right? And I know I accepted that I don't like this type of education. I don't like. I like people to be physical here. Then only you have a kind of sense that you are learning. That then only you will have kind of sense that we are teaching. We can discuss. So whatever I said, it's very difficult to get some ideas from you all. That's normal thing. Can't have. Now I had a class this morning. I did it from home. No one was there on the online. No one. The first time I have seen the class, no one was online. There were people when I start the lecture, but suddenly they have disappeared. So they would have, the only thing they have opportunity to later watch this video. So they are actually using that opportunity. But only thing, if you are live connection, you can ask question. You are losing that opportunity when you don't want to involve in the discussion live. Anyway, if you have any question, I can answer. So if you don't have a question, we can wind up the class. Right. If you don't have any questions, so we will wind up the class. So thank you very much for participating, and I hope that you have learned something, whatever the discussion we had during these 5 days. Thank you, students. All the very best.
Thank you.